everyone, and welcome to today's Explainer. I want you to think about your pantry for just a second. Chances are you've got a bottle of Heinz ketchup sitting in your fridge right now, or maybe a familiar blue box of Kraft macaroni and cheese tucked away on a shelf, right? These aren't just household staples. We're talking about absolute titans of the global food industry. But today, we're looking at a truly fascinating business case study involving these exact giants. It is a captivating cautionary tale about the paradox of extreme corporate efficiency. We're going to unpack exactly what happens when a brilliant financial strategy goes just a little too far and ends up turning a corporate powerhouse into a prime example of strategic starvation.
Now, cutting costs, that sounds like universally good business, doesn't it? I mean, on paper, the math is just incredibly satisfying. You lower your expenses, you get higher margins, improved profitability, and stronger shareholder returns. Wall Street absolutely loves a lean, mean cost-cutting machine because it translates immediately into massive quarterly profits. But this provocative paradox is at the very heart of our story today. How on earth could saving billions of dollars and dramatically improving financial margins accidentally starve a global food giant?
Okay, let's dive into this. To really understand the strategy, we have to look back at the golden era, right after the massive mega merger between Kraft and Heinz. The new leadership stepped in and they ruthlessly simplified operations across the board. They removed duplication because, hey, you don't need two corporate HR departments when one will do the job perfectly well. They slashed supply chain costs, significantly reduced operational overhead, and took a massive axe to marketing spending. We aren't just talking about trimming the edges here. Budgets for iconic, beloved advertising campaigns were completely gutted. And initially, well, it worked beautifully. Margins improved at a breakneck pace, costs plummeted, and the company's financial discipline looked incredibly strong. Investors were, for sure, absolutely thrilled.
But to achieve those staggering, multi-billion-dollar cuts, leadership didn't just ask nicely. They deployed a very specific financial weapon, and that weapon is rooted entirely in a single number, 0. This wasn't just a digit. It became this ruthless corporate philosophy that was about to completely shake the foundation of the newly merged company.
The strategy they famously unleashed is called zero-based budgeting. So, instead of doing what most companies do, which is, looking at last year's budget, tweaking it for a little inflation, and moving on, zero-based budgeting treats every single dollar of last year's budget as if it's on trial. Every single department has to justify its existence and its expenses repeatedly, starting completely from scratch or zero. That dollar literally has to prove its innocence to avoid the chopping block. Now, supporters correctly pointed out that this approach massively increases accountability. It stops bloated, lazy spending right in its tracks. And to be completely fair, in many administrative areas of Kraft Heinz, it absolutely succeeded in eliminating unnecessary corporate waste.
Now, what's really interesting about this is the hidden risk in treating all spending with such deep suspicion, because actually, not all spending is wasteful. Zero-based budgeting acts like a massive short-term sugar rush for a business. You get those lower expenses and higher margins right away, and everybody pops champagne. But on the flip side, what happens to your long-term competitiveness? When you start cutting the very investments needed for future growth, things like product innovation, brand development, deep consumer research, you trade that short-term sugar rush for long-term starvation. If a company becomes obsessively focused on wringing out every single penny today, they unintentionally handicap their own ability to grow tomorrow.
Which brings us to part 1, the innovation crisis and stagnation in a shifting market.
You see, consumer markets are living, breathing things. They evolve constantly. While executives inside the walls of Kraft Heinz were aggressively cutting costs, staring intensely at their financial spreadsheets, the external world was rapidly shifting right under their feet. Consumers were migrating away from heavily processed pantry staples and moving toward health-conscious products, organic options, and premium fresh experiences. Suddenly, everyone wanted avocado toast and artisanal snacks. Smaller, highly agile challenger brands were perfectly positioned to just eat up market share because they were deeply in tune with these new lifestyle trends. Meanwhile, the traditional packaged foods, those massive legacy brands Kraft Heinz heavily relied on, were kind of stuck in the past, facing immense pressure to modernize, but without the budget to actually pull it off. And because they were so laser-focused on hitting those aggressive budget targets, they entered a brutal cycle of decline. Think of corporate adaptability sort of like a chameleon, changing colors to match its environment. When you underinvest in brand renewal and market research, you effectively strip away the chameleon's ability to change. Food companies simply cannot rely forever on historical brand strength alone. They absolutely need continuous innovation to stay relevant. But creating new products, testing new recipes, launching fresh marketing campaigns, all of that costs money.
Without that investment, brand momentum fades. You end up highly efficient operationally, sure, but completely paralyzed strategically when the market demands something new.
So you're probably wondering, why didn't the brilliant financial minds running the company see the danger sooner? Well, this is the dramatic irony of the whole Kraft Heinz story. Massive legacy brands are a lot like ancient Roman pillars. From the outside, they can look incredibly solid and majestic for years, completely hiding the structural cracks forming deep inside. A brand like Heinz Ketchup has such immense historical recognition that it's going to continue generating strong revenue long after its true, cutting-edge consumer relevance has started to drop. This structural reality temporarily propped up Kraft Heinz's financials, effectively masking the gradual decline. The alarm bells were completely muffled by the sheer momentum of their century-old success.
Which leads us to this critical quote, representing the brutal dilemma executives face every single day. Short-term success can sometimes create long-term weakness. This right here is the thematic anchor of our entire explainer. Do you aggressively cut investments to make your quarterly numbers look incredible, knowing it'll keep Wall Street and your shareholders ecstatic today? Or do you protect your R&D budget, knowing that starving your brand of innovation is a silent killer? The terrifying part of this dilemma is that the negative effects of underinvestment usually only appear years down the line, exactly when it is vastly harder and much more expensive to fix.
Moving on to part 2, the unseen rot, and how a culture of caution sets in.
And this brilliantly illustrates how the impact of relentless cost-cutting goes way beyond balance sheets and product lines. It fundamentally alters human behavior. Put yourself in the shoes of a brand manager in this environment for a second. When you and your colleagues are constantly dealing with endless restructuring, intense budget pressure, and rigid efficiency targets, what happens? You become exceptionally cautious. If you know your budget's going to be slashed to zero every single quarter, are you going to take a bold, career-risking bet on a crazy new product? Of course not. Decision-making shifts heavily towards simply playing it safe and protecting margins. But in a disrupted, shifting industry, survival requires risk-taking, creativity, and a really high tolerance for uncertainty. The intense focus on efficiency at Kraft Heinz unintentionally crushed the exact innovative spirit they needed to survive, leaving the whole organization disciplined but terrified to try anything new.
All right, that brings us to our final section, part 3, the moral of the story.
Let's run through these core takeaways quickly because they are absolutely essential for understanding any modern business strategy. First off, cost discipline is incredibly important, but it cannot replace genuine competitiveness. A perfectly balanced ledger just doesn't matter if consumers no longer want to buy what you're selling. Second, even the strongest, most historically famous brands require continuous reinvestment and innovation to survive. Nostalgia alone is not going to drive sustainable growth. Third, you have to carefully balance operational efficiency with growth capability. It's like a complex machine, right? If you pull too hard on the efficiency lever, the gears of innovation just grind to a halt. And finally, margin protection does not equal future relevance. Trimming expenses to boost today's profits doesn't automatically mean your strategic health is actually sound for tomorrow.
So was Kraft Heinz wrong to focus on cost reduction in the first place? Well, actually, no, not entirely. Operational efficiency absolutely matters, especially on the razor-thin margins of the grocery business. But this fascinating story reveals that the cuts were successful on paper, yet ultimately a failure in reality. Financial discipline becomes incredibly dangerous when companies start starving the very investments needed to secure their place in the market. So I want to leave you with this provocative question to ponder. When a business relentlessly trims the budget to satisfy the demands of today, are they just cutting costs, or are they actually cutting their future? Thank you so much for joining me for this explainer, and remember, always look a little deeper at what's really hiding behind the balance sheet.